Hello, Mindy.
Hey,
Do you guys see the? Do you guys see that? Do you guys see those candles?
wait,
That might just be a, that
let's
might
see,
just be a.
let's see.
There you go. Wow, 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 wow. Hello, 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 hello. What's that? Tesla recover? Oh, Tesla. Wow. Okay. Is that the? That's it. That's Nvidia. Wow. Okay. Wow, guys. La, big sell off after you came? No, that was because the market was struggling. Mindy, can we just watch like SPY for a bit? Just to see, just to see like the reaction. Where's the VIX? Most likely pumping. That's what it's doing. Look at that. Are you guys ready for this? So again, Powell speaks in about 27 minutes. We're gonna try and find everything we can from Twitter and whatnot. Just what's happening there with the Fed meeting. And here we go again pumping. Look at that, right? It's just up and downs. Look at the candles that came before that and look at what's happening now as the minutes come out and uh
For a minute there, like when I was sitting here, I saw the red. I was like, "Oh, here we go."
yeah,
But now everything's fine. We're
yeah,
good for now.
yeah. Back to its like normal range. It's not like it's pumping or going anywhere. It's back in the same place. Tiffany, let's go, Tiffany. How are you? You took a second of work to come see the disaster. Okay, let's go. Crypto, listening while you work, Crypto. Thank you for the tweet, Crypto Crazy. Thank you. Hi, Beth. I bought all the presents, Mindy. There you go,
Nice,
Beth.
Beth.
Oh, look at that thing go! Look at that off the screen. Wow, look at that from like red to green, guys. Right, volatile. So we have this article here from just from the Fed is about to make its biggest decision of the year. Everything but tech is sitting on the edge waiting for Powell, guys. Waiting for Big Daddy Powell. What do we so la 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 la? Right, US stocks are trading moderately lower ahead of the federal right, the final Fed decision of 2021. The Fed will release its new policy at 2, right? Fed Jerome Powell will hold the press conference at 2:30. Policymakers will have to walk a tightrope. Tightrope. Inflation is lasting longer than it expected, right? But rising COVID infections mean ripping the band-aid too quickly could sting, sending the economy south. I feel like you guys' economy is it's so tech investors weren't waiting around for Powell to tell us what we already know. Look at that, guys. Right again, the market's front running. The Fed is about to get serious about inflation, yet the rest of the market is waiting with bated breath. So again, the Dow is flat, the S&P is down 0.2%, the Nasdaq is down 1%, right? Little less than 1% there. Um, so what's this here? It's crazy. It's crazy, crazy. Look at that. It's a crazy, crazy momentous Fed day. Okay, okay. What else is on here? Stocks flat. Blah blah blah. Blah blah blah. Right? A whole bunch of stuff. Uh, you know, we just have to wait and see what Powell has to say here.
Oh, Bitcoin likes it. Whatever's happening.
Bitcoin is liking it.
Yeah, almost at 49.
49. Okay, there you go. Right. So the scared this people were scared, so the market panicked, and now it's recovering. So recovering here. Bitcoin boom. Let's go Bitcoin.
Yeah, here we go.
Bitcoin.
I don't think I've ever seen
50?
these percentages move like this quick, like just so volatile on my watch list. Like
Yeah.
they're like moving tickers. It's
Yeah.
crazy.
Yeah. Let's go, guys. Play Santa. Oh, will he be the Grinch? Seems like he's playing Santa already. Seems like he's playing Santa. Bitcoin's at 1 minute. Okay, just
Oh,
49,000.
you want me to put it up with it or no?
Okay. Yes, please. Yeah. E- We have the stock index. Now we have Bitcoin for the crypto market. Went from deep red to green in 2 minutes. Yeah, it's a bow trap. Again, Sojo. We'll find out when he speaks though, right? Scary. Yeah, it's gonna be volatile for the next 30 minutes, the next hour. It's gonna be volatile. So again, be safe, please, and thank you. Be safe, be safe,
Whew.
be safe, and yeah, go from there. La, la, la. Hedge against inflation. There you go. 955. 955. So what else? What else do we have here? What else do we have here? Yeah, Mindy, let me know if you see anything on
Yeah, I'm
the.
looking at Twitter, just random people talking.
Yeah. I
People
want to see
saying
what.
SPY
Yeah.
to 500.
Okay.
In tech valuations, Bob Pisani.
I want to see what this is here. Pause the music.
Why is that Tesla and not SPY? That was weird. Sorry,
I
guys.
was wondering. Oh, that's okay. I was wondering. Yeah.
I thought it was. Eh,
Huts is
never mind.
pumping more. Yeah, because Bitcoin is pumping. It's a fake pump. You a fake pump. Just kidding. No, it might just be. It might just be a fake pump. All right, it might just be a fake pump. So let me see what this says here.
Fed meeting this afternoon, and as we've seen some significant fluctuations in tech valuations, Bob Pisani has a story about how they're connected. Bob.
They are indeed, John. Since Powell indicated that the Fed would stop characterizing higher inflation as, quote, transitory, that was on November 30th, techs had some trouble advancing. Take a look. Particularly software stocks have had trouble. They're down roughly 10%. This is since November 30th. Semis are down 5%. Kathy Wood's ARK Innovation Fund is down 14%. Big software names like Cloudflare, Zscaler, PagerDuty, Datadog, and Adobe, they're down 11 to 30% since Powell turned hawkish. Why is this happening? Because stocks that have high cash flows and high valuations, tech stocks, they get hit because higher rates and bonds compete with stocks. Why take risk with high valuations if you can get the same performance with bonds with less risk? Investors instead have fled to cash or into Apple, which is up 8% since November 30th, and it's become something of a safe haven for tech investors. The Fed's aggressive about face is calling into questions sky-high valuations on many tech names. JP Morgan software analyst Sterling Auty was on this show yesterday, reducing his ratings on Adobe and a dozen other software stocks. He says cash flow growth rates are what matters for tech valuations. He wrote yesterday, quote, "This has been consistent since 2000, and it brings into focus whether growth rates can sustain or moderate at a tolerable level to keep valuations propped up." And that's the issue, propping up valuations. This may be the first of many reevaluations. Other tech analysts and strategists are also nervous right now. Justin Post, who's Bank of America's internet analyst, noted today that after a strong 2020, his internet stock universe was down 13% in 2021. In a note to clients this morning, he said, quote, our B of A strategy team has a somewhat bearish view on the S&P returns in 2022, given high valuations and potential impact of higher interest rates, and we expect a choppy 2022. Now, his main hope for a stronger 2022, valuations have already begun to adjust, and Carl, we are seeing that now. We'll see if that continues into the new year.
Woo.
Look at that thing go. What's Bitcoin sitting at, Mindy?
49.
Big Daddy Powell, guys. Big Daddy Powell. That's what he got that name from. Big Daddy Powell, because he pumps the markets. At least from my experience. So we just have to wait and see what happens when he starts speaking, and see if this is just a fake pump, and then we go from there. So, yeah, again, the Fed, that meeting is at 2:30. Right, 2:30, 2:30 there. Let me make sure we're good to go there. You can see here, again, that meeting starts at 2:30. Right there. So we just have to wait till 2:30 and see what he says. See if that makes things go boom, boom, boom. Somebody say wayo.
Real.
That's what's happening, guys. There you go. You're selling it at 51, Ash? Okay, selling your Bitcoin at 51. Okay. Solana is running. Should be. Everything should be trying to recover here now as the market recovers. So crush it next year after Christmas. Educate it. Crash it next year. Next year. Okay. Yeah, Noir, that's your friend. That's your guy. Big Daddy Powell. You guys are causing fake pumps. Unbelievable. Yeah, no, the S&P looks good there, guys. Again, those minutes are out. We can cover that, but I just want to, again, most likely something good in there. But we're just gonna wait and see what Powell has to say, right? So, we can see what's causing this pump in a few minutes here. I'm trying to figure out the green color. I'm trying to figure out what the green color is. The green is your account growing. That's your account. Marlo says account just grew over $8,000. Let's go, Marlo.
Dang.
Yep. Let's go. Wait and buy in December, Ash. Buy in December. Recovering my portfolio. I saw it go down to today. JA. Okay. Well, I'm glad you're recovering here now. So let's see if Bitcoin here can get back about 50K. I think that's what a lot of these smaller tokens, smaller coins would be waiting for. 50K and the Fed, right? So hopefully this is a start of something. The Santa Claus rally. There you go.
Oh,
Let's go. Do you guys think? Just type in Santa or Grinch. What do you guys think? Santa or Grinch? Let us know. Mindy, Santa or Grinch?
Santa.
Santa. Okay. We want Santa, guys. We want Santa. Next year, I'm saving all my liquid cash. Only invest in December 2022. Buy all the divs. Superstars. Okay. Okay. Ho ho ho. Okay. Ho ho ho. You guys all Santa. Santa. Please, Santa. Okay. Da Grinch. Mama says Santa. Okay, Santa. Feel like we're all projecting our what we want from this meeting. That's what we're doing here. Elf, Gary, waiting for the elf. You've been a good year this. You've been a good boy this year. It's Santa. I want Santa. Feel Grinch. So now we need Peter to say Grinch. Okay, where's Peter? Peter, come say Grinch. Hamza says what's happening. The big is the Fed. The Fed is speaking. So you beg for Santa. Okay, we hope it's Santa. We hope it's Santa.
Santa.
Santa Claus. Let me see if there's anything else here, guys, on the Twitter.
Yeah, I don't really see like a whole lot. Just people saying Spider 500, pump the market,
Yeah.
pump, rockets, rockets, rockets.
Yo.
Someone said buy anything and everything.
You thinking everything. Anything and everything.
Someone said the difference between 2 p.m. and 2:30 is Powell's not talking.
Yep.
Someone said 500. Someone
That's
said,
pretty funny, Mindy.
huh?
Dude, that's pretty funny. Because Power's gonna come crash it. That's the difference. 2 p.m. and 2:30. Power's gonna come in at 2:30, crash it all. Um, no, 2:30. Superstars. Honeymoon. Crypto. Yeah,
Bye
that's
bye,
funny.
Sir Whitehouse.
Way Let's see here, guys. So again, this article came out about 7 minutes ago. Something about follow along for real-time updates of the big Fed decision in Powell's press conference. So again, the conference starts whenever there. When again 2:30 for those guys as well. So Fed sees three rate hikes in 2022. On Wednesday, a dedicated indicated it sees as many as three rate hikes in 2022, as the central bank contends with a recent surge in inflation. So this is a quote here from, not sure who that is from. So supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. The statement also noted that job gains have been solid in recent months, and the unemployment rate has declined substantially. The Fed also expects to raise twice more in 2023, followed by another rate hike in 2024. So again, these are from the minutes, right? So these are from the minutes. That's why the market seems to like this. The market seems to like what's happening here. The fact that let me finish reading here. So 9 minutes ago, right? Fed keeps rates unchanged, speeds up pace for asset purchase taper. So the Federal Reserve kept interest rates unchanged Wednesday, adding that it will aggressively dial back its monthly bond buying program. Going forward, the Fed will be buying 60 billion a month in assets. Right, that's half the level prior to the November taper. Central bank officials also see three rate hikes in 2022. Stock slightly lower ahead of Fed announcements. Okay, that was quite a bit ago, right? So that was before the pump, right? So the market seems to be liking what's happening here, right? The fact that the rates are unchanged, right? The fact that again rates 2022 there and whatever else is happening, right? So these are just updates that are coming through before the meeting happens. Print more money, print more money, Mindy. Can you guys print more money? More money?
My heck.
Oh my heck! Oh, if only I had a time machine. uh, yeah. Find the most. Yeah. Nah, don't bet Grinch, Beth. Yeah. That is not positive, Beth. I know. I know, Beth. I know. I know. I know. I know. It's la, la. Peter. What? If I had something negative to say, no, nothing to say to you, Peter. Nothing. Zero words. So there we go, right? So again, these updates are the last updates that just came through before the meeting here. So the market seems to like that. So there's one more update here. Seems like so 2 minutes ago, stocks cut losses after Fed decision, right? So again, market seems to like what's happening. The S&P 500, the Dow Jones Industrial Average, and the Nasdaq cut their losses Wednesday, right, to trade higher as investors digested the Fed's latest monetary policy announcement. The Fed was up 0.05. The S&P was up 0.05, while the Dow Jones higher, tech gain, okay, whatever, right? So the market seems to like what's happening here. Again, we might not think it's positive, but these stocks are okay, right? They're recovering here. So sell it before, announce something, and then they pump, right? Always the opposite, it seems like. Always the opposite. It's the same thing that we do with earnings, where we, if something's pumping into earnings, we short it. If it's dumping into earnings, we buy it, right? Because usually opposite. So again, that's what's happening there. The Fed again speaks in 10 minutes. 10 minutes. What are the charts looking like?
Bullish. This one's looking good. Bitcoin looking all right. Got to get back about 49 and 50.
Yeah.
But yeah, seems like everybody likes it.
Yeah. Yep. Above 50K, Stuart. Yeah, absolutely. It's positivity. Positivity. Hey Ken, hi. To push into the 60s again, Hamza. I think the hope would be that again, first things first, we don't crash, right? And then we recover back above 50K. So instead of looking for the 60s. What time is where you are? It is where we are. It is 12:20. Um, Ken says hi, Mindy.
Hi.
Hope you're. Yeah, I'm good. Alpha, how are you? Hi, Richard. Hello, Richard. Where have you been? Where have you been? 219, yeah, 219 for you guys. So 10 minutes here the Fed speaks, and then we're really gonna see the volatility of what he's saying. So again, someone tweeted, right, Mindy, that tweet there, the difference between 2 p.m. and 2:30 is that Powell isn't speaking. So let's hope he doesn't cause some disaster. 219 for you, yeah. 7:20 Sierra, that's why those games are so late. That's why those games are so early, Sierra. You guys are way all the way over there. Get to the point, or there'll be a lot of gibberish talk. Raymond, most likely a lot of gibberish talk. Um,
Hmm.
I you right now, Nick. Nick, is it too cold outside? What are you saying? What are you saying? Um, mhm. Are we thinking boat trap or not? Well, I think we're guessing and hoping that it's Santa Claus. Uh, but again, let's just wait and see, right? So I mean, we might as well just get it over with. If they're gonna sell it, sell it. No more games, guys. No more games. Just sell it off, crash it, and let's recover, please and thank you. Right? So, Nick, I know what you mean. I haven't been outside, Nick. So, oh, for knowledge, Nick, absolutely, why not? 12 a.m. 12 a.m. in India, right? Wide-eyed, open to listen to Fed decision. Let's go. I need to know.
Go.
Yeah, again, guys. So if you can copy the link to this conference and share it on Twitter, I know Crypto Crazy. Thank you. He's working and listening, so thank you for sharing. I see that tweet. So yeah, share it and take something. Let's go. This guy's playing us all. Raymond. No crash. Okay, Beth. No negative crash words. Okay, no crash words through tracements, pullbacks. Hey. I'm waiting for the Fed, and then Arsenal versus West Ham. I'm waiting two superstars. I'm waiting. I want to watch it. I was like, oh, Fed or Arsenal. Well, not that I care. I wanna. I don't know. Hi, Amber. Don't make me fly to Canada. Canada travel restrictions, Beth. The travel restrictions. You can see the negativity. Matt source that we are going to have one big spike and then what does that even mean? You're gonna have one. What does that mean, Mindy? One big spike, and then a bounce back. What does that
No
even mean?
idea.
Plus, we will see 1 minute people join this video. 1 million. Okay, 1 mm. What people join this video today? Okay, let's go, Noah. It's safe for now. Yeah, I'm safe for now. Travel restrictions, guys. Sell for from 51K. So has to go there first. Ash? No. I mean, again, so we're waiting for the Fed here to speak, and we're going to be rotating between the charts and what Powell is saying to see how the market is reacting to what he's saying, right? So that's all we have to wait for. Um, let's get back about 50K first, right, Ash? Or 49, like Mindy was saying, and then go from there. You can see the S&P selling off and Bitcoin selling off at the same time. Why? Because they're all waiting for the same thing, right? They're waiting for the meeting, right, to see
Mhm.
how Power responds to those questions. 500K mug giveaway. Let's go, Noor. Let's go, guys. Smash a like if you haven't already. Hit that subscribe if you're new to the channel. Share the link as well if you want to. Um, if it means a flight to London and takes to Wembley, absolutely not, George. Take us to Wembley. To Wembley.
Let's go.
Let's go. Are you ready? 6 minutes,
I'm
means.
ready.
You ready for the
Yeah.
rubbish?
Mm-hmm.
For the rubbish.
Mm-hmm.
They not said they are raising the rates. Yeah. So explain. 2022, right? So we covered the article. The Fed is planning on doing 3 rate hikes in 2022. So that's what they've said there. So we wait and see. we wait and see. I think the market for now again is waiting for those questions, right? For people to ask them like questions, proper questions, and then we can go from there.
I'm ready.
Mindy wants Santa. You guys want Santa. Um, I don't know what I want. Um, because I'm
I
tired of
want
it.
Santa just for old time's sake.
Yeah,
But I'm ready for anything.
yeah.
Bring on the Grinch if you want it.
Let's go. Give, do we have a chance? Let's go, Josh. What kind of rubbish is this today, 100 flags? Come on, you. What kind of rubbish is this today? Yeah, let's go. So Superstars Mafia says, let's all meet in London. I'm doing the hosting. Superstars, we're gonna hold you to that. You know, we're coming to London, right? To watch some FPL, some EPL. You know, we're coming, right? Champions League, something something. So you
London.
better get ready. Mindy's coming to watch Champions League. Josh is coming.
I will not be there.
Mindy,
I'm
you're still
sorry.
scared of flights? Unbelievable.
I don't
Oh my god.
fly.
Mindy doesn't fly, guys. Get a flight. Anytime? Okay, let's go. Christy, of course. You know, Gary, everybody. 8,000 people show up there. Yep. Stuart is gonna be there, of course, because he lives like right around somewhere close. So we have 4 minutes, guys, and then we can pull up the conference and then go from there. So make sure we're good to go there.
Yeah, I sent you something on your DMs.
Okay.
Yeah, nothing on Twitter anymore. Everyone's kind of, let's see, latest. People just talking about what time it starts. They said, you did it, Dad. Thanks. Someone said Santa's coming 10 days early. Yeah, everyone's just getting ready. They said all-time highs, all-time highs. We should see. We'll see. Let's go.
There you go.
Good thing Mindy can drive to Canada. I know. I can drive. I can drive.
La la la. Let's see here. What happens when you jingle Santa's balls? Noor, what happens when you jingle
Wild.
Santa's balls? A white Christmas? Unbelievable. Look at these things selling off now together, guys. Right? Together. You know, Bitcoin selling off, the S&P selling off together here. The meeting is in 2 minutes, right? No super chat pump. Okay. Here you go. It's looks as if the Grinch is coming back from to roast peace. I know, right? Santa showed his face. The Grinch was like, you know what, old man is can't no more games here. He sold puppets. Look at that sell off there, guys. So again, that meeting is happening here soon. In less than 2 minutes here. So we have it ready to go. I'm gonna put
Ah,
that's last.
holy Hannah.
No. I know.
Man.
Alrighty, so yeah, back to the charts, guys. Meeting hasn't started yet, so I'm gonna mute that and then mute my la, la, la.
Here we go.
Ready.
We're ready.
There you go. Holy Santa, let's win. You're buying the dip. Okay. Spam roots at times, right? So when you tickle Santa Claus, reindeer, they giggle and glee, just chilling. Okay. Uh, here we go. Less than a minute here. Lambo, when you buy it, smack. Oh, Uh-oh. So has the meeting started there as the market is looking to start moving there?
I think so.
Where is it? Come on. La, la, la. Come on. Ain't nobody got time for this.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the Federal Open Market Committee kept interest rates near zero and updated its assessment of the progress that the economy has made toward the criteria specified in the committee's forward guidance for interest rates. In addition, in light of the strengthening labor market and elevated inflation pressures, we decided to speed up the reductions in our asset purchases. As I will explain, economic developments and changes in the outlook warrant this evolution of monetary policy, which will continue to provide appropriate support for the economy. Economic activity is on track to expand at a robust pace this year, reflecting progress on vaccinations and the reopening of the economy. Aggregate demand remains very strong, buoyed by fiscal and monetary policy support and the healthy financial positions of households and businesses. The rise in COVID cases in recent weeks, along with the emergence of the Omicron variant, pose risks to the outlook. Notwithstanding the effects of the virus and supply constraints, FOMC participants continue to foresee rapid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 5.5% this year and 4% next year. Amid improving labor market conditions and very strong demand for workers, the economy has been making rapid progress toward maximum employment. Job gains have been solid in recent months, averaging 378,000 per month over the last 3 months. The unemployment rate has declined substantially, falling 0.6 of a percentage point since our last meeting and reaching 4.2% in November. The recent improvements in labor market conditions have narrowed the differences in employment across groups, especially for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor force participation showed a welcome rise in November, but remains subdued, in part reflecting the aging of the population and retirements. In addition, some who otherwise would be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. At the same time, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. How long the labor shortages will persist is unclear, particularly if additional waves of the virus occur. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate declining to 3.5% by the end of the year. Compared with the projections made in September, participants have revised their unemployment rate projections noticeably lower for this year and next. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. As a result, overall inflation is running well above our 2% longer run goal and will likely continue to do so well into next year. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. Wages have also risen briskly, but thus far, wage growth has not been a major contributor to the elevated levels of inflation. We are attentive to the risks that persistent real wage growth in excess of productivity could put to upward pressure on inflation. like most forecasters, we continue to expect inflation to decline to levels closer to our 2% longer run goal by the end of next year. The median inflation projection of FOMC participants falls from 5.3% this year to 2.6% next year. This trajectory is notably higher than projected in September. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are committed to our price stability goal. We will use our tools both to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. We will be watching carefully to see whether the economy is evolving in line with expectations. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee reaffirmed the 0 to 1/4% target range for the federal funds rate. We also updated our assessment of the progress the economy has made toward the criteria specified in our forward guidance for the federal funds rate. With inflation having exceeded 2% for some time, the committee expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessments of maximum employment. All FOMC participants forecast that this remaining test will be met next year. The median projection for the appropriate level of the federal funds rate is 0.9% at the end of 2022, about a half percentage point higher than projected in September. Participants expect a gradual pace of policy firming, with the level of the federal funds rate generally near estimates of its long-run level by the end of 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. At today's meeting, the committee also decided to double the pace of reductions in its asset purchases. Beginning in mid-January, we will reduce the monthly pace of our net asset purchases by $20 billion for Treasury securities and $10 billion for agency mortgage-backed securities. If the economy evolves broadly as expected, similar reductions in the pace of net asset purchases will likely be appropriate each month, implying that increases in our securities holdings would cease by mid-March, a few months sooner than we anticipated in early November. We are phasing out our purchases more rapidly because with elevated inflation pressures and a rapidly strengthening labor market, the economy no longer needs increasing amounts of policy support. In addition, a quicker conclusion of our asset purchases will better position policy to address the full range of plausible economic outcomes. We remain prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And even after our balance sheet stops expanding, our holdings of securities will continue to foster accommodative financial conditions. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to complete the recovery in employment and achieve our price stability goal. Thank you. I look forward to your questions.
Thank you, Mr. Chair. We'll go to Rachel from the Washington Post.
Thank you very much, Michelle, and thank you, Chair Powell, for taking our questions. The latest FOMC materials say that the FOMC thinks it will be appropriate to keep rates near zero until labor market conditions reach levels consistent with maximum employment. And there are also 3 rate hikes penciled in the projections for next year. In order to set up those hikes, what will maximum employment have to look like? When will you know that that threshold has been met? And how will that be communicated? Thank you.
So maximum employment, our statement of longer run goals and monetary policy strategy. Maximum employment is something that we look at a broad range of indicators. And those would include, of course, things like the unemployment rate, the labor force participation rate, job openings, wages, flows in and out of the labor force and various parts of the labor force. We'd also tend to look broadly and inclusively at different demographic groups and not just at the headline and aggregate numbers. So that's a judgment for the committee to make. The committee will make a judgment that we've achieved labor market conditions consistent with maximum employment. When it makes that, it is admittedly a judgment call because it's a range of factors. Unlike inflation, where we have one number that sort of dominates, it's a broad range of things. So As I mentioned in my opening remarks, in my view, we are making rapid progress toward maximum employment. And you see that in, of course, in some of the factors that I mentioned.
Great. Thank you. Steve at CNBC.
Thank you, Mr. Chairman. My question is, if it's often said that monetary policy has long and variable lags, how does continuing to buy assets now, even though it's at a slower pace, address the current inflation problem? Won't the impact of today's changes not really have any impact for 6 months or a year down the road on the current inflation problem? And aren't you actually lengthening that time by continuing to buy assets such that it could be not until the long and variable lag after you end purchases sometime in March that you'll start to have any impact on the inflation problem?
So on the first part of your question, which is why not stop purchasing now, I would just say this. We've learned that in dealing with balance sheet issues, we've learned that it's best to take a careful, sort of methodical approach to make adjustments. Markets can be sensitive to it, and we thought that this was a doubling of the speed. We're basically 2 meetings away now from finishing the taper, and we thought that was the appropriate way to go. So we announced that's what will happen. The question of long and variable lags is an interesting one. That's Milton Friedman's famous statement, and I do think that in this world where where the global financial markets are connected together, financial conditions can change very quickly. And my own sense is that they get into financial conditions affect the economy fairly rapidly, longer than the traditional thought of, a year or 18 months, shorter than that, rather. But in addition, when we communicate about what we're going to do, the markets move immediately to that. So financial conditions are changing to reflect, the forecast that we made, and basically, which was, I think, fairly in line with what markets were expecting. But financial conditions don't wait to change until things actually happen. They change on the expectation of things happening. So I don't think it's a question of having to wait.
Can I just follow up in thinking about having to wait? Is it still the policy or the position of the committee that you will not raise rates until the taper is complete? Thank you.
Yes, the sense of that, of course, being that buying assets is adding accommodation and raising rates is removing accommodation. Since we're 2 meetings away from completing the taper, assuming things go as expected, I think if we wanted to lift off before then you would stop the taper potentially sooner. But it's not something I expect to happen. But I do not think it would be appropriate, and we don't find ourselves in a situation where we might have to raise rates while we're still purchasing assets.
Okay, let's go to Colby at the FT.
Thank you, Michelle. Chair Powell, I'm curious exactly how much distance you think there should be between the end of the taper and the first interest rate increase. Back in 2014, the guidance that was given was for the Fed funds rate to remain at the target level for a considerable time after the end of the asset purchase program. Is that an approach you support now, or does the current economic situation warrant something a bit different? Thank you.
So we haven't made any decision of that nature. And so, no, I wouldn't say that's our position at all. We really haven't taken a position on that. I will say that we did talk today. We had our first discussion about the balance sheet, for example, and we went through the way the sequence of events regarding the runoff and that sort of thing with the balance sheet last time. And I think people thought that was an interesting discussion. They thought that it was informative, but people pointed out that this is a significantly different economic situation that we have at the current time, and that the differences that we see now would tend to influence how we think about the balance sheet. And the same thing would be true about raising rates. I don't foresee that there would be that kind of very extended wait at this time. The economy is so much stronger. I was here at the Fed when we lifted off the last time, and the economy is so much stronger now. It's so much closer to full employment. Inflation is running well above target, and growth is well above potential. There wouldn't be the need for that kind of long delay. Having said that, we'll make this decision in coming meetings, and it's not a decision that the committee has really focused on yet.
Let's go to Nick at the Wall Street Journal.
Thank you. Nick Tamaros at the Wall Street Journal. Chair Powell, in March, you answered a question about maximum employment like this. You said 4% would be a nice unemployment rate to get to, but it'll take more than that to get to maximum employment. More recently, you have hinted at a possible distinction between the level of maximum employment that's achievable in the short run versus in the long run. Has your view of the level of maximum employment changed this year? And if so, how? And how close is the economy right now to your judgment of the short run level of maximum employment? Thank you.
Right. So the thing is, we're not going back to the same economy we had in February of 2020. And I think early on, the sense was that's where we were headed. The post-pandemic labor market and the economy in general will be different. And the maximum level of employment that's consistent with price stability evolves over time within a business cycle and over a longer period, in part reflecting evolution of the factors that affect labor supply, including those related to the pandemic. So I would say, look, we're at 4.2% now, and the unemployment rate has been dropping very quickly. So we're already in the vicinity of 4%. The way in which the important metric that has been disappointing really has been labor force participation, of course, where we had I had certainly thought that last fall, as unemployment insurance ran off, as vaccinations increased, as schools reopened, that we would see a significant surge, if you will, or at least a surge in labor force participation. So we've begun to see some improvement. We've certainly welcomed the 0.2 improvement that we got in the November report. But I do think that it feels likely now that the return to higher participation is going to take longer. And in fact, that's been the pattern in past cycles, that labor force participation has tended to recover in the wake of a strong recovery in unemployment, which is what we're getting right now. So it could well have been that this cycle was different because of the short nature of it and the very strong, the number of job openings, for example. You would have thought that would have pulled people back in, but really it's the pandemic, it's a range of factors. But the reality is we don't have a strong labor force participation recovery yet, and we may not have it for some time. At the same time, we have to make policy now. And inflation is well above target, so this is something we need to take into account.
If I could follow up, you've talked recently about risk management, and so does that mean that the committee might feel compelled to raise interest rates before you're convinced that you've achieved the employment test in your forward guidance?
So this is not at all a decision that the committee has made, but you're really asking a question about how our framework works. And yes, there's a provision, what used to be called the balanced approach provision, that says in effect that in situations in which the pursuit of the maximum employment goal and the price stability goal are not complementary, we have to take account of the distance from the goal and the speed at which we're approaching it. And so that is in effect an off-ramp which could, in concept, be taken, and it's in our framework. It's been in our framework a long time. I've talked about it on a number of occasions. It is a provision that would enable us to, in this case, because of high inflation, move before achieving maximum employment. Now, as I said, we're making rapid progress toward maximum employment in my thinking, in my opinion, and I don't at all know that we'll have to invoke that paragraph. But just as a factual matter, that is part of our framework and has been really for a very long time.
Thank you.
Thanks. We'll go to Howard at Reuters.
Thanks, as usual. So I guess I got to ask about the elephant in the room, which is the Omicron variant. This seems to already be pushing one of your colleagues, the Bank of England, off its course. Things have evolved very fast there. hasn't quite hit the shores of the U.S. in full force yet that people seem to expect it to. So I'm wondering, in your feelings about this, are you convinced that this is going to be perhaps a more infectious but less serious variant of the virus, or are you simply confident that the U.S. economy can continue its divorce from the pandemic?
Well, I think there's a lot of uncertainty, which is why we called it out in our statement, our post-meeting statement, as a risk. We follow the same experts, and we talk privately to the same experts that everyone else does, and read the same articles in the paper and the same research. And so you mentioned the early assessment is highly transmissible, perhaps not as severe, some continuing protection from existing vaccines and also existing immunity from having had the disease. That's a first draft. We're a long way from knowing what it will turn out to be. It may well come to the United States and replace Delta as the dominant variant fairly quickly. That could easily happen. I think it's going to be the effect on the economy, and that will depend, on how much it suppresses demand as opposed to suppressing supply. It is not clear how big the effects would be on either inflation or growth or hiring. On top of what's already going on, which is quite a strong, wave of Delta that's hitting large parts of the country across the northern United States and all the way to the eastern seaboard, and now coming down. We're having quite a wave of Delta. So coming in on top of that, again, it's very difficult to say what the economic effects would be. I do think wave upon wave, people are learning to live with this. More and more people are getting vaccinated. So people who get the new variant, it affects them much less than it tends to affect in the aggregate people who are not vaccinated. So the more people get vaccinated, the less the economic effect. It won't have an economic effect. Delta had an effect of slowing down hiring, and it actually it had an effect on global supply chains, and that sort of that hurt the process of the global supply chains getting worked out. So it can have an economic effect. I just think at this point we don't know much. We'll know a whole lot more in 3 weeks, and we'll know more than that in 6 weeks.
But if I could follow up, you're clearly from a risk standpoint comfortable putting away one of your tools pretty soon, which sort of implies that whatever Omicron brings, you're comfortable the economy can handle it without quantitative easing.
Yes. I think if you look at the state of the economy and the strength of demand, the strength of just overall demand, the strength of demand for labor, look at inflation, look at wages. I think moving forward the end of our taper by a few months is really an appropriate thing to do. And I think really Omicron doesn't really have much to do with that.
Thank you.
Let's go to Gina at the New York Times.
Hey, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about what prompted your recent pivot toward greater wariness around inflation.
Sure. So I guess I would go back and, it's been a continual process, really. Inflation really popped up right in the late spring last year. And we had a view, it was very, very widely held in the forecasting community, that this would be temporary. It was quite narrow. A limited number of factors were causing it. And there was a decent amount of evidence to support that view that it would be temporary or transitory, as we said. Certainly, we had 5 months of declining month-on-month, monthly readings of inflation, but we didn't see much in the way of progress on labor supply or on other supply side issues. Then in September, I'd say after Labor Day, it started to become clear that this was both larger in its effect on inflation and more persistent. And of course, I said so on many occasions. And one of the consequences of that is that we moved the taper forward. And it's a much faster taper than had been planned. So we've been adapting. I've been saying we're adapting our policy. So come to your real question. We got the ECI reading on the eve of the November meeting. It was the Friday before the November meeting, and it was very high, 5.7% reading for the employment compensation index for the third quarter, not annualized, for the third quarter, just before the meeting. And I thought for a second there whether we should increase our taper. Decided to go ahead with what we had socialized. Then right after that, we got the next Friday after the meeting, 2 days after the meeting, we got a very strong employment report and revisions to prior readings and no increase in labor supply. And the Friday after that, we got the CPI, which was a very high reading. And I honestly, at that point, really decided that I thought we needed to look at speeding up the taper, and we went to work on that. So that's really what happened. It was essentially higher inflation and faster, turns out much faster progress in the labor market. Really what's happening is the unemployment rate is seems to be catching up with a lot of the other readings of a tight labor market, 0.6 over one cycle. So that's really what happened. And, widely supported in the committee today, as you can see, unanimous vote. But beyond that, I think widely supported this move.
If I could just follow up quickly, you noted that CI was one of the things that made you nervous, but you also said earlier that you don't see signs that wages are actually factoring into inflation yet. And I guess I wonder how you think about sort of the wage picture as you're making these assessments.
Right. So what I said, you quoted me correctly. It's so far we don't see wages are not a big part of the high inflation story that we're seeing. As you look forward, let's assume that the goods economy does sort itself out and supply chains get working again, and maybe there's a rebalancing back to services and all that kinds of thing. But what that leaves behind is the other things that can lead to persistent inflation. In particular, we don't see this yet, but if you had something where real wages were persistently above productivity growth, that puts upward pressure on firms, and they raise prices. It would take something that was persistent and material for that to happen, and we don't see that yet. But with the kind of hot labor market readings, wages we're seeing, it's something that we're watching. And the other thing, of course, is rents, which are very important. Owner's equivalent rent and rent. That's another thing which is very economically sensitive. Unlike the things that are causing the inflation now, this is economically sensitive, and so would be expected to move up. And so as some things go down, the question is, where will we be when we come out the other side of this? And we need to keep our eyes on those things.
Thank you.
Thanks. We'll go to Chris at the AP.
Thank you. Well, next year you could see growth slowing, and you could see some disinflation, particularly if the Omicron variant does spread more widely. Would you delay rate hikes in that situation? And how would you think about that? And also, how would you explain rate hikes if you do follow through in that kind of situation with inflation fading and growth slowing? How would you explain rate hikes to the public, particularly those who may still be looking for work?
Well, as you know, the SEP is not a plan. It's not something we debate, negotiate over, or really discuss in terms of what the right answer should be. People write down their assumptions, their assessment of appropriate policy based on their economic forecast. And so the median, what you're talking about, the 3 rate increases, that's the median of the committee. The median of the committee is also that growth will be 4%, and then unemployment will be 3.5% by the end of the year. So that's a really strong economy. And of course, if the economy turns out to be quite different from that, then so will the rate. No one will say, oh, we can't change our policy because we wrote something down in December. That no one's ever said that or will. It will. The actual rate decisions we make will depend on our evolving assessment of the forecast. So, for example, if the economy were to slow down significantly, then you would expect that would have an effect of slowing down rate increases. But we'd have to, we look at our 2 goals, maximum employment and price stability, and we make policy based on them, and not with respect to what we wrote down in a prior SEP.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to follow up on maximum employment. So, the new framework was basically designed as I understand it, so that there was a de-emphasis on guessing where inflation would pick up because of employment. And basically, you were going to wait until you saw the whites of the eyes of inflation, and that's how you would kind of know that you reached maximum employment. So I'm wondering, you've talked a lot about the different ways that you might measure maximum employment, but from what I understand, and that's still basically the way that you know that you're there, is inflation. So is that understanding correct? And how are those signals likely to be clear right now, given that you have inflation that's caused by these supply chain disruptions that might also lead to inflation in wages and those sorts of things? So how do you sort of like tease out the signal of maximum employment? Okay,
so let me start by saying that the inflation that we got was not at all the inflation we were looking for or talking about in the framework. It really was a completely different thing. It was to do with, strong monetary policy and fiscal stimulus into an economy that was recovering rapidly and in which there were these supply side barriers, which effectively led to, in certain parts of the economy, of what you might call a vertical supply curve. So, automobile purchases are very interest rate sensitive, and you would think demand would drive up the quantity of cars, but it can't because they don't have semiconductors. So that was a very different kind of inflation. This is not the inflation we were looking for under our framework at all. It's nothing to do with our framework, and the way we've approached it is really nothing to do with our framework. But come to maximum employment, which is really your question. How do you know? So I think you look at prices and quantities. If you want to look at maximum employment, you look at prices and quantities, and the main price you look at is wages. It's one of the things you look at, and it's so I mentioned a number of the things. You could get to 20 if you wanted to easily, but labor force participation, the unemployment rate, different age groups of prime age labor force participation in particular gets a lot of focus. The JOLTS data get a lot of focus. And wages, that's really one of the great signals. The quits rate is another one. The quits rate is really one of the very best indicators, according to a lot of labor economists, because people quit because they feel like they can get a better job. And there's record amounts, historically high levels of that going on, suggesting again that you've got a very tight labor market. So on wages, that's the price indicator we look at to tell us, along with all the other data, whether we have labor market conditions that are consistent with maximum employment. And so that's how we think about it. But the one of the complications is that, again, we've got to make policy in real time. So how do we think about that? If we think we can make labor, participation might move up. Let's say we knew that it would start to move up in 2 years, would we wait 2 years when inflation is running way above target? Probably not. So you have to make an assessment that what is the level of maximum employment that is consistent with price stability in real time is one way to think about it.
Just to kind of follow up on that for a second, if you do raise interest rates next year and you're not certain whether you're at maximum employment, I mean, are you all going to point, when you raise interest rates, are you going to point to ways in which the labor market could still improve?
Yes, I mean, I absolutely. I think whether or not we say we're at labor market conditions consistent with maximum employment next year, we would all be open and I think expect over time that the level of maximum employment that's consistent with price stability would increase further over time. For example, through increasing participation. So we would not in any way want to foreclose the idea that the labor market can get even better. But again, with inflation as high as it is, we have to make policy in real time. We've got to make that assessment in real time.
Thank you. We'll go to Olivia from Bloomberg.
Thank you. Good afternoon, Chair Powell, and thank you for taking our questions. I wanted to follow up on some of your earlier comments about labor force participation. And I wondered, what do you think needs to change in the economy to kind of get a meaningful recovery in labor force participation? And also whether running the economy hot, like in the last expansion, is one way of doing that.
Well, the labor market is, by so many measures, hotter than it ever ran in the last in the last expansion. If you think about it, the ratio of job openings, for example, to vacancies is at all-time highs. Quits, the wages, all those things are even hotter. But what would it take for labor force participation to move up more? That really, why is it low is the question. So there are a bunch of answers, and all of them probably have some validity. Part of it will be that people, for certain people, they don't want to go back in the labor force because either they're medically vulnerable or they're not comfortable going back while COVID is still everywhere. That's one thing. The lack of availability of childcare made for caretakers is certainly part of it, not just for children, but for older people. It has been pointed out by many that the stock market is high, people's portfolios are stronger. They may go back to being a one income rather than a two income family. The same thing with people's houses. People buy they have a mortgage, and with leverage and the house price increases, the equity they have in their home might have doubled, and they might reach the same conclusion. So and people have savings on their balance sheet because of forced savings, and that because they couldn't spend on travel and things like that, and also because of government transfers. So for all of those reasons, and it's hard to know exactly the part each of them plays, we have a situation where we've had a shock to labor force participation that is not unwinding as quickly as many has expected. And people, in effect, a good part of it is voluntary. People, and this is how they want to maximize their welfare, and that's certainly their choice. In other cases, it's something that will abate very quickly if and when the pandemic gets under control. And the longer the pandemic goes on, maybe the less likely that people will come back because they get used to their new life and they lose contact with their old jobs. That's what the evidence would say. So it's a range of things. It isn't that the economy lacks stimulus. Usually in every other expansion, it's that there aren't enough jobs and people can't find jobs, and we're stimulating demand and trying to get demand to come up. That's not the problem here. The problem is a supply side problem, which what it would take to work it out, I think it's going to be time. And for one thing, it would really be to have the pandemic get under control. That's what everyone would really like to see. What does the labor market look like in a world without COVID? That would be the thing that we'd really like to see. But it doesn't look like that's coming anytime soon.
And just to quickly follow up on that, if some of the reason that labor force participation isn't back to, February 2020 levels because people are voluntarily making life decisions that are different, does that make you think we're going to end up at a lower rate overall?
Well, there's a demographic trend underlying all of this. And we actually got above the demographic trend at the end of the last expansion. So one would expect over time that labor force participation would move down because an aging population, the older people are, the lower their participation rate is. So you would expect that the trend would be lower and that over time participation would move down. The question of how much we can get back up closer to where we were in February of 2020, and indeed for the year or so before that, is a good one. And but what we can do is try to create the conditions. There's a lot of good for society when you have a tight but stable labor market where people are coming in, they're getting in the labor force, they're getting paid well. In the labor market we had before, we had the biggest wage increases were going to people at the bottom end for the last couple of years. There were just a lot of really desirable aspects of a labor market like that. Higher participation is one of them, and we'd love to get back there. But again, ultimately, the tools that we have, which are essentially to stimulate demand and also to control inflation. Really, it might be one of the two big threats to getting back to maximum employment is actually high inflation, because to get back to where we were, the evidence grows that it's going to take some time. And what we need is another long expansion like the ones we've been having over the last 40 years. We've had, I think, 3 of the 4 longest in our recorded history, including the last one, which was the longest in our recorded history. That's what it would really take to get back to the kind of labor market we'd like to see. And to have that happen, we need to make sure that we maintain price stability.
Okay, let's go to Edward Lawrence at Fox.
Thanks. Thanks, Michelle, and thanks for taking the question, Chair Powell. So I was looking at the census data there for estimated monthly changes on sales. And what you're seeing is fewer people spending at restaurants and drinking places, more people spending at grocery stores. You see electronic sales down 4.6% month over month. Also, department store sales down 5.4% month over month. How concerned, or what is your level of concern the consumer may be turning away from this economy or pulling back because of inflation, the virus, or something else? Thank you.
We see consumer expenses very strong in this quarter. I don't know, Edward, whether you're talking about more shopping online versus shopping in the store, but consumer demand is very strong. Incomes are very strong, because people are going back to work and they're getting wage increases. Admittedly, some of the wage increases is being eaten away by inflation, but nonetheless, incomes overall are going up really significantly because of increased employment, and spending has been strong. There may be something in the seasonality that this year's holiday spending may have been pulled forward, and of course there may be effects from Delta, and there might be going forward from Omicron. But fundamentally, though, the consumer is really healthy, and we expect personal consumption expenditures to be pretty strong in the fourth quarter.
Okay, let's go to Mike at Bloomberg.
Mr. Chairman, the median forecast for inflation in this month's or this meeting's economic projections has been revised up significantly for 2021, but barely moved for 2022 and 2023. You've said you expect inflation to fall significantly. Is that because you're going to raise interest rates, or because the virus is going to fade and the effects are going to fade? In other words, is it a question of when, not if, you raise interest rates? And does it suggest that maybe your critics are correct and you might be afraid you're behind the curve?
So actually, I'm looking at the SEP here, and the median forecasts for core and headline inflation did move up by 0.4 each. So that's a significant, in an SEP, that's a pretty significant move up. It's based on both of those things, I suppose. I do think there's a broad expectation among forecasters, including our own, that the bottlenecks will alleviate sometime over the course of this year. If you look at where blue chip forecasts are, which is the group of well-resourced large forecasting operations with a long track record, they'll show inflation coming back down significantly toward the back end of next year. I would say as well that our policy should begin to have an effect. There will be a lag, but it should begin to have an effect on that as well. That's the most likely case. I guess what the thing I would want to say, though, is we can't act as though that's a certainty, and we're not going to act as though that's a certainty. There's a real risk now, I believe, that inflation may be more persistent, and that may be putting inflation expectations under pressure, and that the risk of higher inflation becoming entrenched has increased. It's certainly increased. I don't think it's high at this moment, but I think it's increased. And I think that's part of the reason behind our move today, is to put ourselves in a position to be able to deal with that risk. And I think we are in a position to deal with that risk. We need to see more data. We need to see how the inflation data and all the data evolve in coming months. But we are prepared to use our tools to make sure that higher inflation doesn't get entrenched. For one reason, as I just mentioned, it's one of the two big threats, the other being the pandemic itself, to getting back to maximum employment.
Let's go to Michael Derby, The Wall Street Journal.
Yeah, thank you for taking my question. So as the Fed shifts towards an accelerated taper, I wonder what your read is on financial stability risks right now. I mean, these periods can be, it seems like the taper process has gone fairly smooth so far, but, what do you see in terms of stability risks? Are there any parts of the financial sector that concern you right now? And are there any significant systemic issues that are on your radar, maybe from the cryptocurrency sector or something like that?
We have had now for a decade and more, a 4-part financial stability framework that we use so we can hold ourselves to the same kind of framework and not just treat each event individually. And there are four key areas: asset valuations, debt owed by households and businesses, funding risk, and leverage among financial institutions. So I would say asset valuations, I'm going to go really superficially here, but asset valuations are somewhat elevated, I would say. Debt owed by businesses, and households. Households are in very strong financial shape. Businesses actually have a lot of debt, but their default rates are very, very low. But nonetheless, it's something we're watching. Funding risk is by and large low among financial institutions, but we do see money market funds as a vulnerability, and would applaud the SEC's action this week. Leverage among financial institutions is low in the sense that capital is high. So overall, financial stability. And that's how I would make an overall characteristic, but we break it down into those pieces. In terms of the things that we're looking at, it's the things we've already talked about to some extent. It's the emergence of a new variant that could lead to significant economic. If there were to be a variant, for example, that were quite resistant to vaccines, it could have another significant effect on the economy. We don't see that. We don't have any basis for thinking that the new variant that we have is that one, but it's certainly one we're looking at. I would say, cyber risk, the risk of a successful cyber attack is, for me, always the most, one that we would be very difficult to deal with. I think we know how to deal with bad loans and things like that. I think more a cyber attack that were to take down a major financial institution or financial market utility would be a really significant financial stability risk that we haven't actually faced yet. So I could go on with a list of horribles, but I think that's a decent picture of where I would start.
How about the cryptocurrency issues? Anything that worries you there that's going on in there in terms of, it's obviously a lot's happening in that sector. Is that concern you at all?
I think the concerns there are not so much current financial stability concerns. I, of course, would support the views expressed in the President's Working Group report on stablecoins. Stablecoins can certainly be a useful, efficient, consumer-serving part of the financial system if they're properly regulated, and right now they aren't, and they have the potential to scale, particularly if they were to be associated with one of the very large tech networks that exist, and you could have a payment network that was immediately systemically important, close to immediately systemically important, that didn't have appropriate regulation and protections. The public relies on the government and the Fed in particular to make sure that the payment system is safe and reliable, as well as the dollar, and to provide a safe and reliable, trusted currency. So, but I do think those are longer term. In terms of the cryptocurrencies, that are really speculative assets, I don't see them as a financial stability concern at the moment. I do think they are risky. They're not backed by anything, and I think there's big consumer issues for consumers who may or may not understand what they're getting, and there's certainly developments in the markets that are worth following, which are really not in our jurisdiction, but things like the kind of leverage that's built into them and those sorts of things is certainly worth watching.
Let's go to Nancy Marshall-Genzer at Marketplace.
Chair Powell. Hi, Chair Powell. Thanks for the question. Going back to inflation, is the Fed behind the curve on getting inflation under control?
So I would say this. I actually think we are well positioned to deal with what's coming, with the range of plausible outcomes that can come. I do, and I think if you look at how we got here, I do think we've been adapting to the incoming data really all the way along, and noticing and calling out that both the effects and the persistence of inflation, of bottlenecks, and labor shortages and things like that. So we've been calling out the fact that were becoming longer and more persistent and larger. And now we're in a position where we're ending our taper within the next, by March in 2 meetings, and we'll be in a position to raise interest rates as and when we think it's appropriate, and we will, to the extent that's appropriate. At the same time, we're going to be seeing a few more months of data. I don't actually think we're out of position now. I think this was an important move for us to make. I think that the data that we got toward the end of the fall was a really strong signal that inflation is more persistent and higher, and that the risk of it remaining higher for longer has grown. And I think we're reacting to that now, and we'll continue to adapt our policy. So I wouldn't look at it that we're behind the curve. I would look at it that we're in position now to take the steps that we'll need to take, in a thoughtful manner to address all of the issues, including that of too high inflation.
Let's go to Evan at Market News.
Hi, Chair Powell. Thank you. I was wondering if we should still be seeing the taper and interest rate hikes as separate. And secondly, in the last cycle, the Fed started shrinking the balance sheet when short-term interest rates were about 1 to 1.25% range. Do you think the FOMC might be able to potentially start running off assets before that this time?
Are they separate? So our interest rate, they are separate tools. So the asset purchases are a separate tool from interest rates. Stopping asset purchases does not remove accommodation. It just stops adding further accommodation, whereas raising interest rates starts to remove accommodation from what is a highly accommodative stance. The extent to which they'll be separated in time is something we haven't really discussed at the committee yet. We will be discussing that obviously in coming meetings. I don't think that the last cycle there was quite a long separation before interest rates. I don't think that's at all likely in this cycle. We're in a very, very different place with high inflation, strong growth, a really strong economy. That as I mentioned, the SEP medians are for 4% growth next year, 3.5% unemployment at the end of the year, and the headline inflation of 2.6% next year, core at 2.7. So this is a strong economy, one in which it's appropriate for interest rate hikes. So they're separate, I would say. Your second question was?
My second question was about runoff.
Runoff, yes.
In the last cycle.
So with the balance sheet, we did have a balance sheet discussion. Sort of a first discussion of balance sheet issues at our meeting this week. We'll have another at the next meeting and another after the meeting. At the meeting after that, I suspect these are interesting issues to discuss. Didn't make any decisions today. We looked back at what happened in the last cycle, and people thought that was interesting and informative. But to one degree or another, people noted that this is just a different situation, and those differences should inform the decisions we make about the balance sheet this time. So haven't made any decisions at all about when runoff would start, but we'll be continuing to, in relation to when either liftoff happens or the end of the taper. But those are exactly the decisions we'll be turning to in coming meetings.
Thank you. We'll go to Scott Horsley at NPR.
Thanks, Mr. Chairman. I think you said a few minutes ago that the inflation that we got during the pandemic was not the inflation that you anticipated when you crafted the framework, and you described it as a collision of a lot of monetary and fiscal stimulus with these supply side hiccups. Does that mean the stimulus was mistaken, or is the inflation just a consequence of that we have to put up with because of that?
No, I'm not expressing any judgment about the stimulus in that comment. What I'm saying is there's a sense among some that you wanted inflation. This is what you wanted. How do you like it? And the truth is, this is not the inflation what we were talking about in the framework was inflation that comes from a tight labor market, right? So we had 3.5% unemployment for a period, and we had inflation that was just barely getting to 2%. And I think in that setting, our thinking was we can afford to wait to raise rates until we see actual inflation rather than preemptive, because no one had seen what 3.5% unemployment would look like with high labor force participation. By the way, no one had seen what it would really look like for an extended period for decades, and we didn't know what the inflationary implications were. Turned out there was barely 2% inflation and no sense that it was gaining momentum and that kind of thing. So we incorporated that into our framework. This is something completely different. That's a situation where you had a very, very high level of employment and low inflation. This is literally the opposite, or it has been the opposite, where we have very high inflation, and we've had it since the labor market was in terrible shape. It had nothing. So far, this inflation has really nothing to do with tightness in the labor market. It does have to do with strong demand, and strong demand was supported by the Fed. It was supported by Congress. I'm not making any judgments on Congress. It's not my job, but I will just say we're coming out of what we certainly hope will be a once in a lifetime, certainly historic, the first really global modern pandemic, which looked at the beginning like it might cause a global depression. And, so we threw a lot of support at it. And what's coming out now is really strong growth, really strong demand, high incomes, and all that kind of thing. People will judge 25 years whether we overdid it or not. But, the reality is we are where we are. And, we think our policy is the right one for the situation that we're in.
Thank you. Let's go to Brian Chung.
Hi, Chairman Powell. Wanted to ask about the bond markets. When you see the 10-year at 146 basis points, do you have any sort of concerns about an environment by which you might be hiking interest rates into? Would you prefer the curve be a little bit steeper? What are you gleaning from the bond market actions over the last 6 weeks?
So I think the short end actions are easy to understand, which is, they're basically very policy sensitive rates at the short end. And it makes sense that's reacting to changes in expectations for policy. I think a lot of things go into the long rates. And the place I would start is just look at global sovereign yields around the world. Look at JGBs, look at bunds, and they're so much lower. You can get a much higher yield on U.S. Treasuries by buying USTs rather than bunds, and you can hedge the currency risk back into yen, back into euros, and still be way ahead. So in a way, it's not surprising that there's a lot of demand for U.S. sovereigns in a world, in a risk-free world where they're yielding so much more than bunds or than JGBs. So that's a big part of it. I also think, there may be some assessment in there of what the neutral rate is or what the terminal rate is. I don't know about that, but I would just say that we write down our own estimates of the terminal rate or the neutral rate of interest. Those are highly uncertain, and we'll make policy based on what we're seeing in the economy rather than based on what a model might say the neutral rate is. We all have the experience of the last cycle, where we all through that cycle were trying to estimate what the neutral rate was, and it turned out, I think we learned a lot from seeing what happens. We ended up cutting rates 3 times after raising them to 2.25% to 2.5%. So I'm not troubled by where the long bond is. I see that it's low. We're really focused on broader financial conditions. We're focused on maximum employment and price stability.
Thank you. For the last question, we'll go to Greg Robb.
Thank you very much. Chair Powell, I was wondering if wanted to give you the opportunity to talk about something I've heard that's been discussed, that, your pivot towards a tighter policy, hawkish policy stance had something to do with the timing of your re-nomination by the president. Thank you.
Sure. I'd be happy to talk about that. So as I mentioned, we got the ECI reading just before the November meeting. We got the labor market report 2 days after the meeting. And then 1 week after that, I think on the 12th of November, we got the CPI reading. It was really the CPI reading in concert with those two And I just came to the view over that weekend that we needed to speed up the taper, and we started working on that. That's a full 10 days or so before the president made a decision on renominating me. So honestly, it had nothing to do with that at all. And I just thought, this is what we got to do. My colleagues were out talking about a faster taper, and that doesn't happen by accident. They were out talking about a faster taper before the president made his decision. So it's a decision that effectively was in more than in train, and to the point where people were talking about it publicly. So that's what happened, and it had absolutely nothing to do with it whatsoever. We're always going to just do what we think is the right thing, and I certainly will always just do what I think the right thing is for the economy and for the people that we serve.
Just a quick follow-up. I guess that some people saying that it was the the stimulus in March that was sort of over. We didn't really need all that stimulus, and that there was talk even then that would be a mistake and it would lead to higher inflation, and perhaps that you didn't push back as much as you might have otherwise.
I didn't push back at all. And the reason I didn't, and there was lots of talk about that, but not from the Fed, because that is not our job. We are not the CBO, and we're not elected by anybody. So we take fiscal policy as it arrives at our front door, and we don't comment. We make our own assessments inside the Fed, but it's really not our role. And I think very important that we stay out of that business, no matter who's in the White House, who's in Congress. It's just not our job, and it's something we avoid pretty assiduously.
Thank you.
Thank you.
Thank you, Mr. Chair. Thank you, everyone.
Mindy.
Hey.
Big Daddy Powell, guys. Look at that. Oh no.
Oh no.
There you go, guys. Look at that. Green on green on green on green. We survived. There you go. Yay. Big Daddy Powell, guys. Tell you don't get a name like that for no reason. How was that for you, Mindy? How was the meeting?
It was good. Everything started pumping and gains were being made in our Discord everywhere.
Yep.
I was just like bouncing back and forth like, holy moly.
Doesn't matter, guys. Powell just had to say something. Just say something. Crypto, stonks, everything going from green to red. Tesla's green, right? Nvidia looking good. S&P green on green on green. Look at that pump. When he started, Mindy, look at that pump. Look at that. From like the very bottom to green, pump on pump on pump, guys. Big Daddy Powell. Santa Claus is coming to town. Let's go. Is it a boat trap? We'll find out into the close, right? Developer, we'll find out into the close. And tomorrow and for the rest of the week. So Ethereum breakout. Let's go ETH. Come on, right? Bitcoin looks better there. So Bitcoin is sitting on what, Mindy? 49 still? 49.2?
Mm-hmm.
Yeah. Let's see if we can get back about 50K tonight. And if you bought let's see if Bitcoin can get back about 50K. Right, that's a key level to be looking for, to watch. And let's see if all these other names, the Manas, the Adas, the Shibas, all these other names can recover. So I like that Powell didn't crush crypto when he had a chance to. So look, what do you? Oh, Shiba, what Shiba at 34? Algorand recovering there a little bit. Elon recovering there a little bit. Doge 18.4, nice, not bad, right? So yeah. There you go.
Nvidia looks good.
There you go. Look at that. And I like that again. The conference is not over and the market is just sitting and holding up those gains, right? It's not like we were waiting for Powell to be finished and then crash. No, we're holding those gains. But nice watching with you. Oh, make gains. Gary, have a wonderful day. Big Daddy Stewart. Alan, you're up nicely. So Alan is up 107% on AMD calls. Thanks to Big Daddy Powell. Let's go. So I'll take a look at AMD here for you. Can you put up my chart, please? And thank you. While I'm looking at this rubbish here.
You want me to put my chart up or yours?
No, mine.
Yeah.
So let's see here. So AMD, I just want to quickly look at AMD and then back to yours. So AMD here, you're asking where you should be selling at. What are we sitting at? 145. That's a nice bump, right? I honestly don't mind this. You might just have to look for a level that you're happy with. If you're happy taking profits, maybe take half of those gains just in case this is a trap somewhere, right? There's nothing wrong with taking those 130. Wow. We dropped all the way to 130. I mean, again, so this is what happens, right? Scare tactic. We dump into an event, and after that, we pump after that, right? So same thing when you go into earnings, right? Earnings, you sell off again. So when you go into earnings, something that we've looked at quite a bit is if you're selling into earnings, okay, well, we want to see a pump after that. We want to see a pump after that. Or if you're pumping into earnings, we want to see a sell off after that. Opposite, just opposite. Here you go. Whatever I said. So 145 here is a key level. Maybe just Alan, maybe watch and see if we can close above 145. If we can, that's a really good step, right? Don't mind it at all here. 145, I can see the next level here would be like 147-ish, 146, 146.25 here. So watch for that level there. It's looking really good, the Alan, right? So, yeah. And the S&P just keeps going here. Doesn't matter, guys. Powell, check out Matic. I'll take a look. 20 contracts, maybe I will sell. Yeah, there you go, Alan. Take some profits, right? Take some profits and then hold the rest and see what happens. Again, that would be my recommendation. So, holding overnight, that's a good question, right? So, yeah, I'm sure there are going to be a lot of people, Josh, that are holding overnight now because this was the big thing, right? People were concerned about this. DocuSigns is pumping as well. I'm happy, James. Good job, right? So good job with that. There, I know I still need to send you a DM and set up a call, but good job on that play there. So good job, guys. Again, don't forget to smash a like if you haven't already. Smash a like. Hit that subscribe if you're new to the channel, and if you want to come join us in Discord, right, come join us. The membership link is right here in the chats. Let's go. And yeah, there you go. AMC over 25. Look at that, guys. Glad it went well. Beth, positivity. Positivity.
Go.
Yeah.
Get back to making some money.
You're fine. Take your time. Okay, sounds good, James. Sounds good. Neo dip today into big events this weekend. I'm sure some people did. I know Marlo was asking. So I'm not sure if he finally 470. What's the all-time high on this thing? 475.54. Wow. The market doesn't care, guys. Inflation. The only time we had some red candles was when Powell talked about inflation. You can see those 3 red candles there. That was the first time in a bit, right? Other than that, it was non-stop pumping, over and over. Let's get these gains back to wait. DocuSigns is back to 155. Let's go, James. I'm sure you're a little bit happier now, right? Aren't you? Good job. 170. Let's see if we can close above 170 here today. We have about what market closes in less than what is that? 23 minutes there. Okay. So let's see if we can close above that level, and then go from there. 980 today. Wow, that's impressive. Look how your list has gone from like red to green, Mindy. Like deep red to green, green, green.
Wow.
Thanks to Big Daddy Powell.
The only one red now is Dogecoin.
Doge's
And
reds. Oh,
this other SPAC I'm
I
watching.
need to take a picture of that, Mindy, and send it to the Doge developer. Says one of these is not like the other. You're right. One of these is not like the
Yeah,
other.
it's sweet when he said one of these is not like the other when Doge was pumping. It's
Yeah.
like, nah, I just want to send this back.
Yeah. Dale says, anyone think go just put in a long term at bottom or from here? I'll take a look, Dale. We can take a look. $28 tomorrow, Aaron. Aaron, it's time for gains. We're over this rubbish. We've had too many red days. We've been concerned about this all week. Right, the Fed meeting. Now that it's over, let's make these gains. Let's make some Christmas gains. Wednesday, Thursday, Friday. Let's go. So next week is Christmas. Is what, Mindy? Is the holiday? That's next week already. Wow.
Yeah.
So next Friday.
Next Thursday's an early day, so the market's gonna close at 11 our time, so 1 o'clock Eastern. And then Friday we have off, Saturday, Sunday, and then going into the following week, we also have that Friday off again for New Year's. So you'll have an early week after that, and following week too. So.
Yeah. Okay. You're right, Andrew. Kevin Hart has been replaced by Big Daddy Powell, guys. That's it. Completed. Those are questions somewhere here.
Said Kevin Hart wasn't cutting it.
No. Aaron says I'm down 10K on Merck. Again, Mindy's talked about this quite a bit about Merck. She's talked about the fact that yeah, Merck just doesn't do it, right? They're way better plays out there than the Merck. Aaron, right? So she talked about this quite a bit. The fact that these guys always get these contracts, and for some reason Merck just doesn't perform. Right? Like it just doesn't, right? So should be careful with that play.
The thing that's holding Merrick back is Pfizer, right? Pfizer came out with the same exact pill, but Merrick's is $750 a dose, and Pfizer's is quite a bit cheaper. So the government probably will be pumping Pfizer's, even though they do talk about Merrick. The dosages are a little bit different in price for like insurance companies and stuff like that. So I think Pfizer will probably be the one that they push. But that's not financial advice, just my opinion. Do your research,
Yeah. There you go. And the mountains, Johnny. Mindy lives in the mountains. That's where all the snow is coming from. All the snow. You know? Thursday the 23rd, the 24th. Okay. Yeah, Aaron, yeah. So be careful. 1 second. Avax, yeah. Come the head and shoulder. Yeah, Musty, there you go. Oh yeah, we had a lot of snow too. A lot of snow. A lot of snow. So less than 20 minutes here is on point. Danielle? Oh, about Merrick? Yeah.
I had one spy put, and that thing is torched. It only cost me like $10, but still, I was like, just in case.
Yeah.
That thing is like negative 500 gazillion %. It was only $10, but still. I just have one just in case, gotta be careful.
Yeah.
And I'm glad it was torched. I feel better.
Yeah. I went ahead and locked in all your profits on AMD. $6,000 in gains. Alan, congrats on the gains. Good job on that play there. AMD guys. Good job. Of 130. Nah. Right, Beth. Beth says it's a relief to see some green. I hope we can hold and continue for the rest of the week. Honestly, right? I hope we can really hold here as we see a little bit of red here now for the first time. So yeah, let's see what happens into the close. Hopefully it's not just again. I think we all feel like it's a band-aid and something else is gonna happen, but at least it wasn't caused by the meeting, Mindy. So
yeah. Please, I'm gonna have to hop off here. I gotta
Okay.
go. But I shall see you guys tomorrow for maybe a green day. Hopefully.
Okay. Sounds good. Sounds good.
I'll see you later. Have fun.
Sounds good. Alrighty. Bye. Mindy's gonna go kill some ducks, guys. Some hunting. Red candles, is that Zach Moore's taking profits? Yeah. No, good job on taking profits on this play. Nothing wrong with that, right, Alan? So as we go into tomorrow, we've had a nice bump here. There's nothing wrong with that at all. So the S&P here, yeah, it's done really well. I mean, we're seeing the first red candles here for that we, these candles are bigger than these. It's because Big Daddy Powell is gone, guys. Not quite, not yet, Beth, not yet. We're not at 50K yet, so not that I'm aware of. Don't worry, we'll know, Beth. We'll know. We all know. There you go. 1 second. $3 calls for proc is what you're looking for, Chase. Oh damn! Here we go. Danielle says, "Oh damn! Here we go, guys." Right. So yeah, the close is really important here. Twins the price and spin by. No, okay, cool. Never mind. Oh, you will sacrifice a goat when we hit 50K subscribers? Or yeah, what do we add? Not quite there yet. Not quite there yet, guys. Uh, like 50, like 50 errands. So smash the like, hit that subscribe, share the link. Let's get to 50. 50 is a cool number. It's a cool number. So let's do that. And Mindy's gonna do the one chip challenge. Josh is gonna some merch giveaway. There's also how yeah, there you go. And then Virus is doing 1.5 million Shiba giveaway. So yeah, smash that like, hit that subscribe, share the link, and yeah, and then we can go from there. Can't wait for the day AMC squeezes. That will pay. That will be payday for a lot of people. It will be right. Not just for AMC people. It's gonna bump up GME. It's gonna bump up Sundial. All these other smaller names. If AMC squeezes, it takes a lot of things with it, right? You know, it's just like it's done the last few times. So the last two times AMC's gone for a nice run. Well, guess what? Sundial's gone with it, and all the other meme names have gone with it, right? So yeah, so AMC squeezing is a good thing for a lot of these meme stocks. Wish, all these other names. So yeah, it's a good thing. So oh yeah, one chip challenge, mama. One chip challenge, guys. So there you go. Yes, Adanel. Yes, yes, yes. Yes. There you go. I hope Mindy's it's not lactose intolerant. She's gonna need some milk with that chip. Well, she wanted to that. You know that meant she wanted to. She wanted to. It's not so there you go. There you go. Oh yeah, Virus, thank you. Yeah, if you want to come join us in Discord, guys, the membership link is right there in the chat. So join Discord. Nah, members, nah, community things, nah. There you go. Nick will supply the milk. Yeah, I don't know if Mindy wants that type of milk, Peter. I was selling off a little bit here for the first time, so that's interesting. What I want to do here, so that's the S&P there. I want to take a look at some names since they close here, guys. Again, BFry has done really well too, right? It's done really well with this news. What's this here? Most of these names have done really well with this news, so that's a really good sign there. I'm going to put up two charts because that's all I want to watch. So I'm going to leave up the S&P right there. Maybe I can put up Tesla or something else, whatever you guys feel like watching here. Again, Tesla's gonna do whatever the S&P wants to do for the most part. So again, hopefully this is not this is just not a momentary bounce here, and then we're back to red tomorrow. Is that what? Because that could very well happen, right? We know that all this nice talk they're doing here is a band-aid. So eventually we're gonna have to have a nice sell-off in the market. So right back to red. Um, Selling off all the gains. Yeah, the market seems to be giving away all those gains. So it seems like we missed Powell, guys. Right? Crypto possible? Yeah, we missed Powell already. We missed him already. Look at that. Powell leaves and we get red candles. Can they pay this guy a little bit more so he can talk for 24 hours? Currently halted. FDA, yeah, there you go. So cards currently halted, pending. There you go. So I want you. Okay, Beth. Okay. I'm behaving, Beth. I'm behaving. Okay, positivity, guys. Positivity is what Beth is asking for. So here we are, trying to recover. Powers what? At the same time, yep. Andrew, Beth, I'm being positive, but look at Andrew and these Stewie, all these right. So good to be back, Dow Jones, Crystal. Good to see you. Welcome back. Powers a rock pull. No, he pumped the well. I don't know what to tell you. Right, not sure what to tell you. It works. Positivity works. Yeah, there you go. So again, the market is trying. We've had a few red candles here. You can see the S&P trying to recover. Tesla here is recovering here a little bit. So there's about 12 minutes left for the market. So again, let's see what happens here into the close. Right, not very much time left here. We miss power. We miss power, guys. Positive, the market is rubbish. Yeah, people are taking gains. James. Yeah. Here we go. Little recovery here now. Let's see here. I just quickly checking to see what's happening here. 45. Okay, good. You know what I want to take a look at? I want to take a look at this link here, because these guys gave us some really good updates in terms of what was happening. Just some key points. I'm not sure there's going to be anything else important here. So 13 minutes ago, the Fed's starting to take the band-aid off. Okay, I think the band-aid. So again, so this guy says I think the band-aid is getting pulled off. The market's been waiting for this, right? It was selling off on the rumor. It's time to buy the events, he says, right? Time to buy the events. Tom Lee of Fundrats says time to buy. He said the market is not disturbed by the Fed's rate forecast, even though it was slightly more aggressive than expected. Right, because there's still it's still an out. He said the out is if Omicron is bad, that's pretty bullish. Wait. If Omicron is the out is if Omicron is bad, that's pretty bullish. Um, Okay, okay. So tech was selling off hard. First people moved the money back to when to re. Okay, cool. Elevated. Okay, cool. I'm just quickly scanning it. We've heard about all these headlines here. I just wanted to quickly see if we missed anything here. So session heights as Powell speaks. Okay, cool. We know that. Says COVID is a risk, but does not impact taper plans. Okay, cool. Just wanted to see a few of those headlines there. So back to TradingView here, guys. And then we can just pay attention to the charts as we recover into the close here. Really good sign, right? Tesla 970. That's pretty impressive. So your next level of resistance here for Tesla is 980, right? So 980 and then back to 1,000. Let's see if we can do that. Looking a lot better than we were going into this. Pretty green pre-market. I don't know though, James. Let's see what happens, right? So. Is there a power shirt in the merch store? Big Daddy, I don't know if you can, I don't know. I don't know if you can do that, Andrew. So, pump it, Powell. Pump it, Powell, guys. That's what we need. A t-shirt like that. Pump it, Powell. La, la, la. Yeah, Andrew, we might need to do some things. Florence, what's VASK Tech? Pump it like Powell? Yeah. Big Papa Powell? Okay, yeah, we can do something if you guys want to. Pump it like Powell. I like that, Peter. There you go. Nah. Is Bloom dying or still has a chance? Your position is Adi. Your position is at 765. Okay, I'll take a look. I'll take a look. Christy, yes. What, Christy? You wanna? Yes. For now, going to move after hours again, Andrew. Of course, those things always moving. Always after hours, pre-market, and then market opens and nothing. 971 here, 972 as the S&P recovers. Look at that! Wow, it's been green the entire year here. So entire year. Super chat, guys. Powell is a new Zach Morris. I'm telling you. Okay, I'm agreeing with the shirt sayings. Okay, sounds good, Christy. Should I keep or sell my stocks? Tim. So Marlo, catch you tomorrow. Thank you again for what you guys do. We are gonna double up tomorrow. Today was a day off. Laters. Let's go, Marlo. Have a good day. See you tomorrow. Thank you for the super chat. 49.5 about time. That was my your lunch signal. Okay, let me take a look here. So again, the S&P is recovering. I want to put a Bitcoin here into the close. So BTC, Bitcoin here. So there we go. Right, again, Bitcoin is recovering. It seems to be following the S&P here, guys, which is interesting, right? Take a look and see. Again, market recovers, Bitcoin recovers. Market goes down, Bitcoin goes down. Market again recovers again here, and you can see Bitcoin recovers. So these two things now, they're now moving together, which is really interesting, right? All waiting for the Fed. There you go. From Fed like Powell. Shirt, I saved the market, Holmes. I saved the market. There you go. I like that actually. One second. Uh, sh- uh, here you go. Uh, See you tomorrow. Should I buy more stocks? By the way, what is stonks? Have you seen that picture, Tim? You haven't seen that picture? Take a look and see what stonks is. It looks like Jeff Bezos, Tim. Like Google stonks on Google that, and you see what it looks like here. Maybe we can actually do that here. So, Google, am I saved here? Yeah, I should save the charts. Google, stonks, right? There you go. So stonks, a deliberate misspelling of stocks, meaning a share of the value of a company. Okay, well, we're gonna ignore that, but I just want to take a look at that image, Tim. Have you seen that? Stonks, right? When things are going higher, when the market is exciting, we call them stonks. A kid, a kid. Okay, Tim. Okay, okay. There you go. Stonks. Should I buy some stonks? Yes, some stonks. Tim. There you go. Some stonks. There we go. Recovering. We're looking good there. We have about another 5 minutes here before the market closes, and then we can come back tonight for the crypto stream, right? So, yeah, market looking good. Didn't seem to do anything for AMC or GME. AMC recovered a little bit, right? M cents with the entire market. AMC recovered. AMC recovered. To hodl or not to hodl? That is the question, Tim. To take some profits and to leave half, Tim. That is the answer. There you go. What stock I try? What's a DOCK? Is that a stock? Let me know what your position is in that. And then I can take a look. Sierra says, "Yeah, crypto stream. Let's go, Sierra." When we do the crypto streams, like what time is it for you? It has to be pretty late, or is it like early mornings? Mm, Oh, Duckcoin. We can take a look at that tonight. We can take a look at that tonight for the crypto stream. Take a look at Smoke. Take a look at SIAC. Okay, for you. Okay, I'll take a look. I'll take a look here. So again, Bitcoin is trying to recover there. Let me take a look at SIAC here. What are we doing? Sea change. Very nice, actually. Like very, very nice. Sense, I'm sure you're really happy with this, right? Because I know you wanted to take some profits. It's done well. We're now sitting at the high today here. As we go into the close, that's a good sign. Resistance at 180 there. This thing's looking fine to me. Closing the way it is a good sign, right? The fact that we've tried to sell off all day today, but eventually recovered is a really good sign. And we're closing at the highs. That's a good message, right? So again, resistance at 180 there, support, nothing's changed. 150 still. Seems like we have a level here for some reason. That might just be a circle because again, that's the main level here at 150. Yeah, a smoke that looks good there to me. I'm not sure what you're asking for. And so if you just want to sell for the end of the day, or what are you asking for? I'm on a night until 6 a.m. Sierra, okay. No. Usually around it's usually scheduled around like 9 p.m. Eastern. So please tonight, please and thank you, virus. What's going on? It's like the biggest level of resistance. Yeah. Thinking about buying some January calls. Sure. Neo. We talked about Neo earlier today. We talked about that $30 level, right? So I know Marlo when it was considering buying around that level. $30 is not bad at all. I know this thing's really struggled today, but again, we talked about buying at around $30 here. So if you picked up those calls, they'd be looking really better. We haven't again, so it's 70 cents from that level, but that's not too bad, right? So we bounced off this level multiple times, so $30 is not the worst level for me here, Alan. Again, the question though is, what happens when we go into tomorrow? That's the question. That's the question, right? Do we just sell off tomorrow, or do we continue pumping? We don't know, right? So there you go. So let me put up BTC here again. base there as we try to recover back to 50K. We need that thing to recover. As again, the S&P is looking really good actually, going for all-time highs. The S&P is going for all-time highs. Wow. Until tomorrow's smoke. Okay. Hope it holds. We see in the crypto stream, Mama, exactly. So I missed my opportunity on SIAC at 150. Yeah, that's okay. I'll take a look, James. Uh, you never got back in? M Sense? Okay. Okay, that's fine. Right, that's fine. That's okay. That was a complete honestly M Sense. That was a complicated one. So the fact that everything sold off and then came back is hard to deal with M Sense. So, what is it called again? Amasan. Okay. Asana. You're looking for this for a long-term play. I think that's what you're looking for, right? So, Asana here. What I kind of like about this is the fact that this level here, 62, 61 here, is the level that we bounced up previously, right? So if I go all the way here to the left, you can see that double bottom there. Well, what came after this double bottom here? We had a nice bump all the way to $140, right? So you can see that again. So go back all the way here to December the 3rd and December the 4th. These candles again found support at this level and bounced, right? So we're doing something very similar here again on December the 14th. December the 14th, today's the 15th. We're having somewhat of a green day here today. So again, that 62 was it, right? What you need to see here now though is, can we break above $70? The market is closed actually. So if you can break above 70 here and hold above that level, you should be good to go higher, right? Why? Because this level has now become resistance. This moving average here is become resistance. You can see that we're failing at $70, right? We're failing to hold above. For this thing to really explode, we need to again hold above that level. If we break below the 62 though, be very careful, and close below that level, be careful, because now we might see a sell-off come, right? So market is closed, guys. Ding ding ding. Close. Pump it like Powell. There you go. I like that. Let's go, Hugh. Come on. Come on. So yeah, we'll do a crypto stream tonight, guys. Again, if you haven't smashed a like yet, take a second, smash a like, hit that subscribe. Come join us in Discord if you want to. In top. Okay, lunch. Okay. Sounds good. What else? Any last questions, guys, before we take a break? Any last questions? Let me know. So again, market is closed almost at all at the highs of the day, which is impressive. Right. So let me put our Bitcoin here as we watch for the last minute or so. BTC. There you go. Okay. Bitcoin. Let's go BTC. Come on. Come on. Let's get back above 50. There you go, Mike. Shiba to 40 cents tonight. Please and thank you. Loving the content, Ken. Let's go. So plus on the scalp, all green. Okay, so M Sense, that's okay, right? Good job. Thank you for watching this with us. Absolutely, Beth. Absolutely. Absolutely. Sierra, I can do a chart and post it in Discord, or we can just take a look at that tonight. Sierra, we can do that tonight, or I can do a chart sometime again in the next hour or so and put it in Discord there. Just watching for, again, honestly for me, Sierra, what I'm looking for is, again, at the very minimum, hold about 42, get back about 50K there. That'd be nice. But I know what you're talking about, and I need to take a look at that actually. So there you go, Beth. Alrighty, guys, we're gonna leave it here. Thank you guys again very much. It was fun. It was fun watching Powell for the last bit there. It's been really been a. There you go, Dev. So yeah, again, thank you for the support as always. We'll see you guys later. Have a good evening, a good morning, a good afternoon, wherever you are. I'll ask you after in the crypto. Okay, sounds good, Sierra. There you go. So yeah, let's get to 50K and do these giveaways, right? So yeah, so share the link, all the fun stuff, and let's get there. Great stream, Andrew. Yeah, that was fun. That was a lot of fun, Andrew. At least we recovered some gains, I guess. Some type of green. There you go, Ken. Thank you, Ken. Have a good evening, guys. Bye, Shaft. Bye, Nun. Bye, Beth. Bye, Andrew. Christy, let's go. Virus, see you. Hopefully, Virus. Hugh, good ending to the day with so much uncertainty. For the rest of the month, or what? Are we excited for the rest of the month? I hope so. Tomorrow is important, right? Amy, we can take a look at CNCX later. Diamond, peace. Alrighty, guys. Have fun, Sierra. Who else is here? Corey, Mamar, James, M Sense, Alan. Have a good evening, guys. Doug, later, Gators. Bye.